Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. Ladies and gentlemen, I'm on a mission to help 1 million people reduce risk in their lives. And I want to thank you, my listeners in the United States, in Thailand, in UK, Australia, Canada, India, Philippines, Singapore, Germany, and Sweden. Thank you all for joining this mission. Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here with featured guest Therapong Vachirapong. Therapong, are you ready to join the mission?
Yeah, go ahead.
All right. Well, let me introduce you to the audience. Therapong is a managing director, banking analyst, and strategist at Phatra Securities. He joined Patrice Securities in 1993 and served as the head of equity research and banking analyst until May of 2018. He covered fundamental equity analysis of Thailand's finance and securities companies. He also covered strategy in the financial institution sector for Thailand and worked closely with BOA Merrill Lynch Research Division Regional Financial Team. He was also a part of the ASEAN investment strategy team at the firm, and he won the award for banking and finance from the Securities Analyst Awards in the year 2006 to 2008 and 2012 to 2013. Therapong, take a moment and tell us about the unique value you are bringing to this wonderful world.
Yeah, I mean, basically, this day, I think the most important in terms of financial markets is actually the personal experiences. I mean, long experiences in the market cycle, and the markets are actually talking about a longer market cycles. Like not bull and bear. For example, like the monthly cycle. Which, for example, like if you actually start working, let's say about 15 years ago, right? I had a meeting with my colleagues during 2018, discussing about interest rate trend and also inflation, and you probably can guess what would be the conclusion of the meeting. Probably about 90% of the people actually they didn't believe in inflation, and they actually didn't believe that the interest rate will go up this high, like in the US. If you were asking people back then, 5.5 would be unimaginable, I would say. So long experience, like people actually get used to the QE period, zero interest rate, and they always use the mean reversal. I would say basically look at 10-year average. People actually cite R star would be about 0 or 0.5. That kind of norm. And then you remember like PIMCO essentially came up with a term of new normal, that interest rate will stay low, the world of inflation is dead, etc., etc. And suddenly, basically now we're actually in a chronic inflation world, and now back and forth between disinflation or maybe a deflation, and going back to maybe back and forth during this time. I think if you actually even myself, I have to actually read back the history of inflation to understand what's going on. People question about theory in terms of monetary theory or in terms of inflation theory, and because of QE, people actually gave up believing in those things and trying to actually come up with a lot of explanations like globalization, relocation of manufacturing to China, etc., etc., to trying to actually justify low inflation. And it's very hard for a lot of people to shift to a new world, like we are no longer at that kind of zero interest rate environment anymore. And that is actually like one of the I would say long experience that would help people to understand that the long market cycle a bit more, rather than like looking at like 10-year, 15-year, in terms of average, and looking in terms of mean reversal, which is actually more the typical Adler would do.
It's interesting. I mean, you and I started about the same time. I moved to Thailand in 1992, teaching finance at university. And then I got a job as an analyst in September of 1993. And I remember that the stock market basically doubled in my first 4 months of sitting in my job. And in January, the number I remember was 1789 for the set index in January of 1994. But it's interesting in this day and age of AI and stuff, where you really see that experience and stories and having lived through things is something that is now a competitive advantage for us as we've been through many different cycles. But I'm just curious, one of the things that I heard a lot of, I know in Thailand, they complain that there's not enough analysts. Maybe analysts want to do other things. I don't know. But I had a friend of mine just tell me the other day that the job of an analyst is going away, and it's already gone, and it's just a dying, breed. And I have my questions about that, but I'm curious, what you've experienced over the years and what you see now as far as the job of an analyst.
Okay. Well, I can think of quickly 3, factors that might contribute to that. I think number one, if you remember when Bernanke actually brought about this MMT, this QE, policies, and you basically trying to maybe fight it back a little bit at the beginning of the cycle when valuation actually went too high, interest rate went too low, and then suddenly this kind of momentum keep on going, and fundamental analysis actually has suffered, cannot keep up with the momentum of the liquidity driven market, and a lot of them actually got it wrong. Couldn't really actually expand by any theory. For example, you have 17 trillion of bonds actually trading a negative yield, for example. If valuation would be infinity in terms of using a discount rate at the negative number. So that's number one. The QE actually destroy all the things that we use as a principle of fundamental analysis. I think the second thing also, I would say, basically because the structural change that's been happening in this time around, from QE, to maybe some sort of an aging population everywhere, including Thailand, with actually one of the fastest aging, country that I've seen. We actually gone from aging to aged in 28 years. Sorry, not 28 years, sorry, 18 years.
Wow.
Faster than any country that I can actually look at the statistic. So that actually been a major force, in terms of changes. And a lot of equity analysts actually couldn't really actually understand what's going on, because this thing happened like in 50, 60 year cycle. The last cycle that you see the population shrink would probably be like the end of World War II. After that, you have baby boom, and then you have still an ongoing of population growth. And you remember, like maybe 20 years ago, some writer actually wrote a paper that the global or the world would be overly populated. Right? So that kind of prediction always wrong, but now on the high side. And now we have an aging society, and that affect like China, affect Japan, 40 years ago, and now affecting Thailand for the last 10 years. I think that kind of thing that people actually cannot really come around and understand what's gonna impact the economy and also impact the fundamental analysis. So that would be the second thing. I think third thing that comes to my mind is basically like it's basically because of structural change in terms of regulations. If you remember when European regulator
MiFID II,
the MiFID, yeah, and gave a birth to the passive fund, including ETF. I remember 15 years ago, kind of long fund, value funds or fundamentals, fund was booming at that time. But after MiFID, had come out, we can sort of see clearly that all the business of these active funds had actually gone away, to more passive, and that actually is it kind of it had indirect effects on the demand of fundamental analysis, right? For example, you look at the largest fund management, like BlackRock, they have more passive fund than active fund, and some of the active funds actually using hedge fund, which actually use less and less fundamental analysis. And also, you look at Thailand. Now, about 20 to 30% of the trading volume now is not on the value trade. It's basically on high frequency trade, which actually rely on algorithm, like intraday trade, arbitrage trade, for example. And that actually use a lot less in terms of service of equity analysts. So those three things happening in the same way at the same time. So maybe that's why equity analysts have a hard time to continue to do what they used to do.
And what kind of advice do you give to young people these days that are thinking about getting into the finance industry? Like, I was just teaching a group of students at Chula who are young, fourth year students wanting to get out there and get to work. I'm curious what you say to them now.
Even myself have to adopt the new technologies. We now actually have quant analysis. We have, I think, you have to learn technology to get your speed, up to the market, because I think all the trading in all the investment world now probably going to even more in the future, going to the technology based kind of platforms. So I think that basically now this day, knowing fundamental analysis, knowing the all these models, not clear enough, not enough to actually keep up with the pace of the global financial market developments. So I even actually told my my colleagues here when they graduate from bachelor degree, and they've been thinking about whether or not they should pursue the master degree or maybe a PhD degree, and they asked me for some advices, and I said no, you should not actually go change. And we look at artificial intelligence like AI. I think that's going to have a profound impact in the financial market, including the job of the equity analyst. Keep an eye on that. Don't actually look back. You have to look forward. What's gonna come? And I think technology will come in a big way.
And my last question before we get into the big question is there any research that you've been doing recently that have some interesting conclusions, or anything that's interesting to you that you've been working on or have worked on in the past year or so? Or
well, I have two tracks. I mean, one track I'm actually covering Thailand, and anyone who actually been following my work, I've been actually underweighting Thailand for the past 7 years, 8 years now. And I actually advising, it's actually against our business anyway. So I've been advising investors not to invest in Thailand. So that's my take. And sales team, firstly, they don't actually like that idea. To stay bearish that long is actually pretty bad for business. So I'm working on that. Let's see what's gonna come up next. I mean, most people now think that because Thailand is one of the worst markets this year. So, practically people say, okay, one of the worst last year will be better this year. That's actually going to be like, the trend. I would probably not going to be surprised, all Thailand strategists, would write year ahead piece for Thailand in a positive tone. But I doubt that, in terms of fundamentals, would Thailand overcome all the structural headwinds or not?
So is Thailand like dead? I mean, it's not, because as you say, after this long of a period of underperforming and all that's, certainly in the price, and people have been disappointed for a while. And I'm just curious, like, and you've just highlighted that there's some people that they like to just, say, well, what was bad will become good and what was good will become bad. But that's not necessarily a compelling argument. But I'm just curious, like, one or two or three things that you see that Thailand just can't overcome, such as, let's say, population, situation or workforce, or I don't know. What are the things that you think that make it such that Thailand is somewhat dead? And then maybe one or two things of how you think that Thailand could come back.
Sure. Well, I think that definitely. For me, I just met some of the regulators, from the fiscal side and also from the monetary side. I don't get the feeling that they actually up into it. Maybe because of political situation in Thailand in the past, 12, 15 years, we don't have any political consensus to reform the economy, and we need reforms. That's very clear. I haven't actually got a sense. People actually politicians love to have quick wins, stimulus, free money, handout, subsidy, and still contribute like that. I don't think it will work. I think that's number one. Number two, I'm actually going to take back some of what I said is actually good or bad. Probably does not really matter to market that much. I think it will be what market would like to see is an incremental change. If bad become incrementally good, that's okay for the market. If good market become incrementally bad, the market doesn't like it. So basically, it's a rate of change, I would say, that affect share prices. Now, people actually hope for like China, for example, they expect rate of change to be coming from fiscal stimulus, and it didn't come. And the same thing now, people expect fiscal stimulus to be big, and some of the policy will be implemented. I think they'll be disappointed, in my view, because I think we lack of political consensus. I think thirdly, especially, I think the market actually linked to monetary policy and linked to the credit cycle, and that's multi-year cycle. And you look at Thailand today, the credit cycle is actually at the peak. And what I'm saying is actually, the peak is actually higher than 1997, if you remember, when we have Tom Yam Kung crisis. At that time, private debt GDP is about 135%, but we're running at about 8%, current account deficit. And it blows up because we use a lot of the capital, foreign capital to invest in the non-tradable goods. And then we have to devalue currency. At that time, private debt was high, but mostly it was actually been affected pretty significantly because the 135 also include the external debt. So when you devalue currency, like 135 become 150, in 1 month, for example. So that kind of debt cycle.
Yeah, I remember about 25% of total loans by the time we got to 1996 or 1997, 25% were foreign, US dollar denominated versus 5%, when the kind of BIBF and the liberalization stuff was announced. So there was definitely a lot more exposure. Is there a lot less foreign currency exposure these days, or is it
less, a lot less?
Right.
So we basically become like, a net export of capital. Before we are a net import of capital to invest in Thailand, but basically we invest in the wrong way. And the second mistake that Bank of Thailand did is essentially liberalize, the current accounts, but actually fix the exchange rate.
Yeah.
You cannot do that. That's and you are the central bank, you should know better anyway. Fast forward to this year, we're a net exporter of capital, not importer. But that doesn't mean that we don't have any problems. The problem is actually on the opposite side. In that time, we have the external balance issue. Today, we have very weak domestic growth dynamics, and that depress the economy and reduce the imports and reduce investment. So basically, become like low growth, and we don't need capital. So we have excess capital everywhere because a lot less opportunity to invest. If you look at the return on asset of the stock exchange of Thailand, it's pretty low. So you better actually look at Thai company now in the past 10 years. They've been investing overseas I'm talking about the FDI by the Thai company investing in Europe, investing in other country, because in return of the asset in Thailand is too low. That was like 10 years in terms of portfolio change. About 10, 15 years ago, return on equity in Thailand about 25%. Today is 7%. So you will be surprised why I'm so bearish for Thai equity. The 7 is actually how much you deserve in terms of valuation. It's quite difficult. So that will be the second thing, that the debt level is very peak, and the difference is actually, remember that at that time, the debt level at in 1997 was actually dominated by corporates.
Yep.
Today it was actually mostly
consumer.
That's actually consumer, and that is very difficult to deleverage and become political. So basically, it's a different problem. I'm not saying that which one is the worst, but basically, you have a different kind of issue there. So I think that would have to. I mean, the government has to think about how to deleverage, and at the meantime, to preserve the growth. So that will be the second thing, that the debt level is actually quite high.
It's going back to maybe, I don't know, 15, 20 years ago, whatever that was. We saw a huge jump in consumer debt, but from what I recall, it was the government at the time trying to get consumers out of the black market borrowing and into conventional places such as Eon, as an example, and others that were trying to provide financing. So even if the formal borrowing of consumers went up a lot, maybe, I don't know, 15 years ago, whenever that was. I guess Eon listed in about 2003 or something like that. But if we go back in that time, even though debt levels were rising, actually you could probably argue that the cost of funding for the average Thai person that could get access to the mainstream sources of financing, actually their costs were going down because they were paying exorbitant rates, to finance their businesses at the markets and other places. But nowadays, everybody's in the formal system, and it's just, it seems like it's a really heavy weight.
Well, I think that's in theory, right? That sounds about right? Trying to maybe bring in all these, loan shark into the legitimate system, and with a much lower interest rate. That sounds okay, and a lot of people buy into that story. But it wasn't true, actually. So a lot of debt actually being created not because they actually refinancing loan shark. These are the additional new loans. According to Bank of Thailand, this owned Bank of Thailand, they believe it also, this theory. But they did actually, I think I remember, like, 6 months ago, give or take, they did a survey. And you know what? The loan shark level has not gone down. Actually, it had increased.
Right.
So presumption of these kind of things, when you do that, you have to actually be careful, because I'm sure that at that time there's no data about loan shark.
Right. Yeah.
Difficult to say, but you presume that these new loans that actually this financial system had created, was basically to refinance loan shark. It was not true, and that's why we have a problem this day, because in the system leverage is so high. Outside the system, leverage is actually not falling down. So in the registered household debt is now about 80-90% GDP, excluding the loan shark. So total is about 171% of GDP. Given that interest rate in Thailand had risen about 200 basis points, that would add roughly about 3 to 4 percentage points in terms of financing costs to the system. Let alone the GDP in Thailand was growing only 2-3%. So that's quite tough.
Right.
I would say maybe you have to think about unconventional. Thailand needs a reflation, not a deleveraging.
Right.
You can do create a vicious circle to the bad debt cycle, and we are actually now in the middle of that, I would say.
One last thing is, I'm just curious where you were on July 2nd, 1997.
I was, still in the same company.
Mm-hmm.
At that time, it was called Phatra Finance. So we are one of the finance that been closed down, and we split our companies. And then, I'm actually in a part of the security, and the part of security actually was sold to Merrill Lynch. At that time, it's still Merrill Lynch.
Yep.
And Merrill Lynch actually 2008 being acquired by Bank of America. So I remember that time quite vividly that we have a problem of NPLs, and we were the one who actually recommending that the government should create the AMC, clean up the NPL so people, the depositor will have confidence in the financial system. But it wasn't there.
Yeah.
I remember at that time we worked with Goldman Sachs. It's not a partner, it's a research corporation. What I did, because I looked at Bank of Thailand data, the NPL at that time, 1996, was only about 3 to 5%. 3 to 5%. And then what I did is actually I calculate, actually by hand, because technology at that time was bad. So I looked at the data of the listed corporates, roughly about 400, about 30 companies. And individually, I actually calculate, interest to EBITDA coverage. And you know what? Bank of Thailand reported NPL of 3%, but the debt of the company that had EBITDA coverage below 1 at that time was about 40% of set listed. So I know for sure that we cannot escape all this crisis, but it was too late to do anything. So
yeah.
But lucky me that I'm actually part of the security side. Have been actually been kind of maybe escape the impact of the financial crisis. Because at that time security was still okay, not having a lot to do with the NPLs.
Well, now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstance leading up to it, and then tell us your story.
Okay. This is when you ask me, when you actually send me the email on this question, gave a lot of thought about it. The problem actually, I couldn't find any big, mistake that I made. And well, so the answer to you on this question would be the problem of this kind of big mistake investment for me is actually I have too few. What that means is actually I'm actually a risk-averse guy because I have pretty strong kind of belief or rule if you like investment rules. Number one rule is actually avoid the maximum drawdown. I know it's actually the drawdown and the 10-day of base market that contribute a lot for your investment return. Right? If you invest through a year and you actually cannot avoid drawdown, your return will be reduced by a lot. But if you miss the 10 base day of the market, you also miss a lot. I'm a kind of guy who actually miss both. So the average return that I have, so basically I'm kind of risk averse. I'm actually like, I always buy stock when it went down a lot. Like and I always like, hold cash when the market actually goes up a lot. So I miss a lot on both sides in any way. So that's my mistake. I think if I may, I should have been, taking a bit more in terms of risk. Because you cannot actually increase your return without taking, a calculated list. For example, you can actually do like 1 to 3, like 1 downside to 3 upsides, or you can actually look at kind of weighted probability of of risk. But I kind of not really doing that at all. So I think that's my mistake. It's the opposite, maybe opposite of your question, but I think it's actually a real problem too. And I know a lot of people here had that. If you look at the wealth management account in Thailand, it had to feel.
Right.
I think that most people in Thailand, in general population, they do not actually have any, I don't have sufficient financial literacy. They leave money on bank account mostly, or maybe bonds, and that's it. And maybe buying lands and gold. So those are actually the majority of financial assets that in average, not the whole. Right. So basically, you look at that. I think I'm trying to think about it. Is actually what the cause of it is? I think maybe because in education in Thailand, you cannot find any single, curriculum from secondary, high school to even university teaching about financial literacy in Thailand. That is very strange. I don't know why, but it's true.
Well, I think it's the case all around. When I look at myself, I always say I was a kind of a poor kid from Ohio, and I always saw myself as not having a lot of money. So even as I started to accumulate, wealth, I was very careful. The other thing is when you're working in the securities business, also you're making good pay. And so you have less of a need to necessarily go out and try to make a huge return. And then the third thing for me was that in 1995, my best friend and I had set up a coffee factory in Thailand. And that company, Coffee Works, now is about getting close to 30 years old. Yeah. But basically, I had to make sure that we never ran out of money and we always had money to pay the payroll. And so I always had to be maybe kind of a barbell strategy where that was extremely high risk investment. And therefore, the other money I had to be really careful with. So what do you think is the source of what caused you to be in a situation where you didn't take as much risk, let's say, as maybe another person?
Okay. You asked me about what I do. So I told you about two tracks. One track is actually doing my job, analyzing Thailand, analyzing, banking system, et cetera, et cetera. The other part of my job is actually because I'm retiring. I'm counting down, now less than 2 months now. And I'm actually worried about my colleague, young colleague who actually just graduated and joined us. And actually, I've been teaching them in terms of financial literacy, how to actually make money. I mean, salary cannot make people rich, that's for sure. So basically, I'm talking about, in terms of compound investment, time value of money. You save early, you make more money. Those kind of things is actually that's my kind of, two track. And also, I'm actually doing it for my PA account because I'm not investing in Thailand. I'm actually investing outside because of compliance. I cannot invest in Thailand, right? Because I have a lot of inside information. So basically, I invest overseas. So that's my two track, teaching the young, colleague, to understand and to actually start investing early, and also, do a little more study, in terms of investing overseas, in terms of macro investment, in terms of, stock, bonds, currency, things like that. I think that's my two track. What I learned, key takeaway, three things, in my part is I look at the history of all kind of, best performing, investor, starting with the best record I have, for example, like Duncan Miller, 30 years with 33%, never a single year of loss. What kind of style he has done now to Paul, to Jones, even like Warren Buffett. And look at the average returns, the past, 20 to 30 years. And it strikes me that I'm actually in the middle, roughly about 14%. So Howard Mark will be 19, for example. He's actually like a risky kind of people who actually invest in the distressed asset. So he's actually the best in terms of calculated risk. And to the hedge fund, for example, like Duncan Miller, actually can invest in all kind of asset, in all kind of cycle. He can short, he can long, basically everything. So he actually maximize all cycle, and it must be very, very good anyway, though. So that's my kind of conclusion. You have to check your style. You cannot be everything. Mine is actually value investing. I invest in in stock that actually I look at interest value, I look at valuation, the story, the company, etc., and then I invest. I'm not actually participating in QE rally, so I miss a lot. That's the momentum. That's the momentum trade. That's the momentum investor.
Right.
A lot of people actually do that, and a lot of people make money on that. Also, the other one is actually like short expert. Like the one who actually short CDO, like Michael Burry, like the big shot and all this thing. So I had to find myself and actually talking to my colleague and say you have to find your own style and just understand it before you actually commit it into the today's investment, because it's really a serious business. So that's my kind of the second thing that I've been doing.
And what's a resource that you'd recommend for a young person? You've talked a little bit about some of the teaching and stuff that you've done, but I'm curious, where would you send them?
What do you mean? No, this is actually in-house mostly.
Right.
I don't do social media. I don't do podcasts. I don't do anything. I'm not active in any Twitter or this stuff. I read news, but not really actually. I do not post anything, in the social media.
And is there any particular book or author that you found over the years that was really valuable for you, or?
Well, there are lots of books, but I think I actually read, the Capital Without Capitalism. Capitalism Without Capital. Sorry, I think that's a good book. How service monopolize, the world, and same. I think the same thing is actually like the Peter Thiel 0 to 1. I think business world has changed, and you have to understand it before you start investing in businesses. In buy stock, meaning that you actually have to understand businesses. I think it will change, deglobalization, technology, and the next thing the world is actually going a path. I think the first thing that I told my colleague is actually you pick the currency first. I think the first thing, because interest rate, I think IMF has become like irrelevant. 2% inflation anchor become, I think, ancient. With the QE program, I think every time financial crisis come, the QE would come, and that would actually set a major ripple effects to the currency world. I'm pretty sure that actually will intensify in the next, let's say, 5 to 10 years. So you have to pick the right currency, and then you have to pick the right market. Especially the risk of geopolitics, you actually have to be very, very mindful of that. So those are actually the things that I actually have read. There's some book like Sleepwalking into the War, in the European War. Some of those actually would help me to reshape and to understand the human history. So I think we are in a mode of sleepwalking as well into a lot of geopolitics things. So I don't have any particular book on that geopolitics, but I think you should maybe start reading all those things as well.
Well, the book is called Capitalism Without Capital, The Rise of the Intangible Economy. Came out in 2018, Jonathan Haskell and Stian Westlake. I believe that's the one you're talking about, right?
Yeah, I actually have some book here. I'm not sure. This one is so good. This same as Esper, the same. I think the author actually wrote a very famous and very popular book, The Psychology of Money. This is the second one. I think it's actually, I'm not sure. See it?
Yep, Morgan Housel.
Yeah, so a lot of these things, I mean, some of them like AI, and also this kind of new I probably haven't read it yet. The new geopolitical map, explaining how these geopolitics will become important. Like you have a lot of driver in terms of geopolitics. Like number one, ideology, like the Crusade War, the democracy versus the socialists, and you have kind of differences during Cold War and now coming back. Second thing is actually the trade war, also actually coming back as well. Proxy war, the superpower war between US and China, definitely. We're linked to the tech, developments, that's for sure. And then you have another one is actually the economic, crisis. I mean, I'm worried that if economic situation in China, doesn't improve, then this would actually intensify.
Mm-hmm.
And next year we have a lot of election in a very big democracy world, starting with Taiwan. Hopefully, it's not really gonna stir up anything.
Mm.
So there are a lot of books related to that. I can't remember all of them.
Yep. And Morgan Housel was episode 255, just when he put out his book, The Psychology of Money, and the book you're talking about is Same as Ever, which he's just come out with. I haven't read that one yet, but I look forward to reading it. Let me ask you, last question. What's your number one goal for the next 12 months?
Well, I think number one goal is actually start investing because I'm retiring. I'm actually building my retirement portfolio. So far, so good. I still have a lot of cash. And my retirement fund will actually add more cash. So I have to deploy it.
Mm.
I have to be careful, not really trying to gauge the market. And I have to try to pick the winner. I mean, people actually talk a lot about the dollarization, talk about this currency here and there. I have my own views. I pick the winning, currency, and pick the winning business, and looking at long-term trend. So I actually have a bit of both, in terms of the bond, the fixed and currency, and a little bit of the alternative. I'm actually now in the next 12 months or so, I'm trying to build it, and hopefully that it will last, in the next, let's say, 5 to 10 years during my retirement life.
Well, you're highly qualified to do that. Well, listeners, there you have it, another story of loss to keep you winning. Remember, I'm on a mission to help 1 million people reduce risk in their lives. As we conclude, Therapong, I want to thank you again for joining our mission, and on behalf of A. Stotz Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
Well, I think it's this time around, I just read a lot of brokers year ahead piece. They normally actually producing like 2024 outlook as a year ahead piece. I couldn't really actually find any conclusive or any kind of theme that I can actually rely on yet. I know the world is actually quite difficult this day, difficult to actually invest. But I think stick to your style, stick to your approach, and be patient. I think at the end of the day, investment is actually not difficult if you actually don't have this mistake of irrational kind of decision. I.e., you have emotionally compromised decision when you see stock price up. You envy your neighborhood that they make money and things like. Don't do that. So basically, you stick to your goal, stick to your principle. You will do well.
Fantastic. Well, that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, let's celebrate that today we added one more person to our mission to help 1 million people reduce risk in their lives. This is your worst podcast host, Andrew Stotz from Bangkok, Thailand, saying, I'll see you on the upside.